The playbook of investments typically involve cash, bonds, and stocks. What are you going to do when the market does that? Good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
And I'm Angi Kinser.
Angi thinks that we're going to talk about the investment playbook.
Yeah. Or asset allocation. I mean, the age-old advice.
I like the playbook better.
I do love that name.
Especially since we're talking about the big game.
Yes.
And you have your Kansas City Chiefs shirt on.
Yes.
And Mahomes played well.
He always plays
It
well.
was a phenomenal. I don't think anybody can beat him, but that's beside the point.
Yeah, I agree. So let's just start real basic. I mean, what is asset allocation?
So it depends how deep you want to go with that conversation, right? So, when somebody walks into my kitchen and they ask how I'm making something, there's some people I answer, and there's some people I kind of just give I'm going to put some spaghetti sauce in it.
Yes.
Right? Right. So when you think about asset allocation, the big three topics are cash, bonds, and stocks. Right?
Yep.
For each one of those, we could spend the next 6 hours talking about.
Well, let's don't do that.
Let's not do that. So as you ask this question, right, so every now and then people will walk into it, and here's one of the dangers of life, and I tell the families that we take care of this every week. What we're taught as CFPs, what I was taught as a professor at Purdue University, what I'm taught as a securities licensed individual, that bonds are safer than stocks. Now, what does that mean, Angi? When I say something safer, what does it mean?
Less risk.
What's that mean?
Well, I guess for the money you put in, it might remain safer in a bond than it would in a stock because a stock's more volatile.
Sounds good on paper, totally wrong.
Okay. Well, I'm just winging it here.
So if you run a screen,
okay,
since we're talking about football,
all right,
and you know what a screenplay is,
yes,
and not everybody does, so I apologize. But if you're running a screenplay, you might get more or less yards than if you ran something in the 3-hole, right, where you're going off the tackle between the guard,
okay,
right, where you're only trying to pick up 1 or 2 yards. Right? You're trying to really
3rd and 1.
Discourage. No, not necessarily. You're trying to discourage the safeties and secondary from getting too loose, right?
Okay.
Because you're running it up the gut, right? But you have less probability of range when you're doing that than you do when you're running a sweep. Make sense?
Yep.
So when people talk about risk in a portfolio, risk really is the variance of getting what you expect. And that's the best way to understand it. So when somebody says a bond is safer than a stock, it typically means or should mean that the volatility or the possible extent of what they might get is less in a bond than it is in a stock. Right?
Okay.
Now we also have to look at where we are in an economy. And if you haven't looked out the window here lately, let me inform you, we're in the middle of a pandemic. A mere 10 years ago, we pumped a few $1 trillion in the economy in a program called QE, and we just did it again. So there's an awful lot of money that is floating around inside of this world. And I think one of the biggest mistakes that people make is to presume that what we have today is the same that we had yesterday without understanding the amount of change that's taken place in the meantime.
Hey, we got a question from Barbara in Muncie. Should my 401k account have the same investments as my investment portfolio?
It would depend on, thanks for the question, Barbara. One, it would depend on the amount of what you had, right? So I think people tend to look at tax treatment as one thing, and secondly, the amount of money they have. So look at what your overall wealth is. That would be one. 2, look at the tax treatment. How much is after tax? How much is tax deferred? How much is in Roth? Remember, you really want all 3 if you can. And then the third is to try to figure out what the best tax application is for each of those. So I always teach people when they're younger to look at your 401k and go, okay, what is my best option inside of my 401k? Because it could be fixed income. If you're in the federal government, the it's unconscionable that the fixed income fund that the federal government has. Nobody else has it. Nobody else can get it. So if you had $250,000 that was inside of your 401k and $250,000 that was out, and we wanted 50% of your money inside of fixed income, it would all be your 401k because the TSP has a fixed income fund that's just nobody can beat. That's typically not what happens for most people. So we would look at it and we would divide it and say, okay, where am I limited in terms of my investment assets? And that would be your 401k typically. It's where you have the most reduced opportunity. And you look at it and you go, okay, this is so the small cap fund here is better than anything else I have, or the S&P 500 is here and it's the least amount of fees and expenses. So you utilize that asset and then you use the rest of your money in somewhere else. I think the biggest mistake that we try to make is we allocate money. I don't know the best word to use this, but we tend to look at money that's in one hand and money that's in another hand, and we try to allocate both uniformly. And that's not really what you want to do. You want to look at it as one system, as one team, and come up with the best allocation you can.
You talked about looking out the window. What about people who are always looking out the window, and let's say they're bothered by or scared of volatility, they're scared it's an election year or whatever. What happens to the people who try to put too much in the cash side of things?
They die.
Well, everyone dies, but
but this is going to be an ugly death. No, I'm serious. Unless you want to die in the next 36 months, you're going to experience something that we've not seen since Angi and I were kids. And, inflation started to take off in 72, 73, 74, peaked in 1980. Went down under Paul Volcker as the Federal Reserve Chairman when Reagan was in office. But we've never seen inflation rates like this. And so inflation has its own issues, right? So when inflation rises, typically you see interest rates rise. Now, Angi, neither you nor I are politicians. They tried, but I said no. Do you think there's anybody in Washington who wants higher interest rates?
No.
No. Right? So their viewpoint is going to be to keep inflation rates as low as they possibly can. What you need to understand as somebody listening to this show is that inflation is really divided between goods and services. The majority of you, and I hope there's a lot of young people out here listening. I really, really do. But the majority of you are probably closer to my age than my daughter's age. And there's a good chance you and I spend more money on services than we do goods. And the bottom line is we can't outsource our haircuts. We can't outsource the people mowing our yards or taking care of our roofs, water heaters, plumbing, or anything else. My point is that the inflation factor for service is much greater than it is for goods. And Washington is going to do everything they can in their power to conceal that basic fact because they don't want to raise your Social Security payment. They don't want to raise interest rates. And so you're going to hear about an arbitrarily low inflation rate, in my opinion.
Barbara has a follow-up question. In retirement, what is the right mix of pre-tax and post-tax in your retirement funds? And does it make a difference if one account, like the 401k, has the most pre-tax?
So the goal, Barbara, and again, thank you for the question. Appreciate your participation tonight. The goal is to be nimble, right? We're talking about the big game. That's the theme for the show this week, right? You want to be nimble. If somebody's going to run a full onslaught, let's just attack the offensive line and see what happens, right? Or if they're going to stand back into secondary, we want to be prepared for whatever that is. And so the ideal objective, in my opinion, is to be 1/3, 1/3, 1/3. 1/3 tax deferred, 1/3 tax free. That's your Roth money. And 1/3 that you've already paid taxes on. Now, in a perfect world, you've paid taxes on all of it, right? That doesn't usually happen for most of us as savers. But that's the match that you want. And then when the tax code's dealt with you, you think about it as a football player, right? Somebody's drawing a sweep, somebody's doing a quarterback sneak, somebody's running off the 3-hole. You're able to pull money out based on your particular situation at that time, based on what the tax code happens to be.
Quickly, is the rate of return always the number one thing you should focus on?
Rate of return matters more than what you think. Einstein said on his deathbed, allegedly, I wasn't there, that I'm not sure what the seven wonders of the world are, but the eighth is clearly compound interest. It is hard to trump compound interest. It really, really is. There's a reason at the Financial Enhancement Group we focus on the journey, where we sit down with people and we say, hey, when you came in, here's what your average return's been. It's great to talk about last year. Man, what a phenomenal year we had. It's great to talk about that. And even 2019, great to talk about that. But at the end of the day, what has been your journey since you've been here? And what should you expect? And don't ever confuse that with the amount that you can withdraw, by the way, during distribution. That's a whole nother story. But I think that's a critical part and a very important lesson to understand. So, hey, you're listening to Consider This Program. I am your host, Joe Clark, along with Angi Kinser. Give Angi a call, 800-928-4001. Get signed up for your Next Steps meeting.